Hey, this is Evan Hutchison, and today I wanted to go over preparing a Form 1040 tax return at a pretty basic level. I'll go over a more complex return on another video. Really, what I want to do right now is help you gain more of an understanding of how the tax return works, how everything flows together. Because if you have that, it's much easier to make informed decisions moving forward, and you probably just want to know how it all works anyways. And maybe you want to try to file your taxes yourself, which is becoming a lot easier these days with the software being more and more advanced. So for now, I want to go over a person. Joe Schmo is his name, and he's got Schedule C earnings, so he's a sole proprietorship. He is a sole proprietor. He's got some investment income, some interest, dividends, capital gains, some rental income. I want to go over pass-through income a little bit. I want to help you calculate qualified business income deduction, help calculate income tax, help calculate self-employment tax. There's a lot we're going to go over in a short amount of time, so I'm going to try to move through it quickly, but at an understanding pace. So there is a lot, as you know, as everybody knows, there is a lot that has changed. This video is being recorded June 15th, 2020. So a lot has changed in the past 3 months as a result of COVID. There have been some new bills passed, which will impact taxes moving forward. We don't have time to get into that today, but I will get into that on a future video. So let's get started. The tax return, this is the personal income tax return. It's Form 1040. It's the 1040 itself is 2 pages long. It's more of a summary of all these other forms and all these other schedules flowing into it. So this is kind of the end result right here. And we'll run through it, but then we'll run through the forms and the schedules too to see how it all interacts. Joe Schmo, he is single. He has no children. He's got some interest and some dividend income, some cap gains, some self-employed income, and some rental income. And most of the income shows up on page 1, the wages all the way down to capital gains. But then, as a result, a few years ago of the Tax Jobs and Cuts Act, they tried to simplify the return a little bit, which that's up for debate. But as a result of that, a lot of the income that you used to see on page 1 is now on a different schedule that flows through. So line 1 is wages. He does not have any wages. But this is where you would report wages. And if you look at a W-2, you can see that this is the W-2 you would receive as an employee. And this box right here is what goes on that line. The federal income tax goes on the second page. I'll show you that too. And then there's also Social Security tax and Medicare tax. These are being withheld automatically by your employer. He is self-employed, so he has to pay these, the Medicare and the Social Security, on the actual tax return, which I will go over. He has to pay this portion, which would be the employee portion, and he also has to pay the employer portion. So he's got to pay this times 2, essentially. If he's above a certain wage limit, the Social Security hits a threshold, and he doesn't have to pay beyond that, but he is not above that wage limit, so he's essentially paying double. So line 1 right here is the box 1 that we just looked at, and then if you go to the second page where we have the taxes and the payments and that sort of thing, other payments, federal income tax right here, line 17, federal income tax withheld, that's where his withholdings would go. But like I said, he doesn't have a W-2. I just wanted to go over that really quickly because that's obviously a very common thing to have on your tax return. The first thing he has is interest and dividends. So these are input on Schedule B. So Schedule B is past all these schedules, past all the schedule 1, 2, and 3, and we're right here. Schedule B shows the interest income at the top and then the dividend income. And when you input the taxes on the tax return, you'll see a spot on the actual software that will allow you to put in qualified dividends. We don't see that right here, but these dividends right here are qualified, which means he gets the long-term capital gain rate for these dividends. And we'll see that on Schedule D, because this is interest is taxed at ordinary rates, ordinary dividends are taxed at ordinary rates, but if your dividends are qualified, they get taxed at long-term rates. Also, if you receive a 1099, that maybe you received a 1099 from a mutual fund, it'll have interest, it'll have stock gains, it'll have dividends, it'll also have capital gain distributions. The capital gain distributions are essentially the fund selling off stocks, and those are taxed at a long-term rate too. So you don't see those on Schedule B at all because they're always taxed at a long-term rate. So you'll see those on Schedule D, which we'll go over in a minute. The Schedule D is Schedule C. We'll go over as well. This is his self-employment income, or this is his sole proprietorship. But Schedule D, since we're already doing interest and dividends, we may as well comb through to this. He's got stock gains of 8,500, or proceeds of 8,500 for stock sales, and then a cost basis of 8,000. So a total gain of 500 for short-term stocks. These are taxed at ordinary rates. His long-term stocks, 10,000 and 8,000 for a gain of 2,000. These are taxed at long-term rates. So we'll go over how these are taxed in detail here in just a little bit. But this $2,000 of long-term gain and the capital gain distribution that he received of $500 and the $5,000 that he received as qualified dividends total $7,500. So he's got $7,500 of long-term capital gains. And the capital gains rates range from 0% to 20% plus a little bit more for some other items we won't go over right now. Most people, many people, including this guy, he's taxed at the 15%. So here it is right here. I just pulled up a random website, but these are the correct numbers. His long-term capital gain rate would be 0% if his income was this low. But his income is in this area right here, so he's being taxed at 15%. And you'll see that his income tax is 24%. So of course that's a 9%. That's a 9% less than what he's ordinarily taxed at. And taxes are at a marginal rate, which we'll go over in a minute too. So we'll just go over how his total tax is computed towards the end of this video. So he's got 7,500 as mentioned of long-term capital gains, and then 500 of short-term. And if you go to and what Congress and what everyone tried to do a few years ago by making the tax return simpler, they created these new schedules: Schedule 1, Schedule 2, and Schedule 3. In Schedule 1, you'll see that it has other income, which used to be on the front page of the 1040, and other deductions, which also used to be on the front page of the 1040. So this line 3, this is where he gets the majority of his income. This is his business. He's got $136,000 of net income. So this flows, the Schedule 1 flows to the 1040. It's just part of this other income number right here. This one, $145,000, which is this plus his rental income. This number comes from, so it flows through to that line on the 1040. It comes from the Schedule C. So his Schedule C is his business, and you'll see here that it includes his revenue and then all of his expenses. He also has a home office. You can see right here. He gets a $1,400 deduction for the use of his office. So he has his revenue, his expenses equals $137,000 minus his home office equals $136,000 of net income. So you can see kind of the normal expenses that people use: advertising, Usually people for the car and truck expense, they might take actual expenses and depreciate their vehicle, or they might just take the mileage, the business mileage that they have driven during the year. There's contract labor, there's depreciation, interest, rent, supplies, office travel. Half of meals are deductible for the most part. And then there's going to also be some other expenses that you might have. For instance, you might have dues and subscriptions that you pay for. You'll put those in another expense. You can put those in detail below on the bottom part of the Schedule C, which we'll go over, because typically you're going to have some expenses that aren't listed on this page right here. So this is where you put all your business expenses. You put your revenue there. You have the income of 136. And as I mentioned earlier, since he's self-employed, he has to pay the employee and the employer portion of the payroll tax. So if we go to Schedule 1 had the income that flowed through to it. Schedule 2, this is Schedule 1 that we already looked at. Schedule 2 has additional taxes. So here's self-employment tax right here. He's having to pay $19,269 in self-employment taxes based on his self-employed income. And we are arriving at that by looking at his employee employee Social Security, employer Social Security, employee Medicare, and employer Medicare. And if we look towards the bottom of the return, there should be a schedule E. Schedule SE. This is where the self-employment tax is being calculated. So he's earning $136,000, right? And they give you the ability to take that down, because if he's earning 136 and technically he is supposed to pay employer taxes on that, and he has not yet, then they're removing that employer portion out before they do the calculation on self-employment tax. So they start with 136,000, as you can see here. The employer portion is 6.2% of Social Security, 1.45% of Medicare. So you add those two together, you have 7.65% of employer payroll taxes. So to get to the net number, if you would have paid those employer taxes, you subtract 7.65 from 100%. 7.65% from 100%, you get 92.35%. You multiply that by the 136K, and your net is 125. So now he's got $125,000 that he received if he would have paid the employer portion. So they let you use that number as the base. So you have $125,000 of tax, and I have a little spreadsheet here. Tax return calculates if you would have had the tax. Your self-employment tax is 15.3% of 125. So essentially 15.3% is 0.06, the Social Security employee, the Social Security employer, the Medicare employee, the Medicare employer. So that's 15.3%. So you're paying the employee and the employer portion after you get this base number. So the 19,269 that we looked at on Schedule D is the self-employment tax. But you remember we had the ability to use this number instead of this number because he should have already paid the employer taxes. So we do get this number as a deduction, which is essentially half of this. It's just the employer portion of the payroll tax. So we get a deduction for this number, and then we pay taxes on this number. So essentially, if he's getting taxed, if he's got a tax rate of 25%, you're saving 25% of this number, because this is a deduction. So he gets a deduction of that amount, which lowers his tax, and he's saving $2,400. He's paying $19,000, so really, his tax as a result of these factors are $16,860. He's paying this amount in tax, and he's got a 24% tax or 25% tax break on this number right here. So if we go back to the return, and go up to the schedules, we can see that we can see the deduction right here, the $9,635. We're getting that as a deduction on the adjustments to income. This is on Schedule 1, so we have the additional income and the adjustments to income. And then on the tax, the Schedule 2, the other tax, we're showing an additional $19,269. So if we go up to the 1040, as a result of being self-employed, he not only has ordinary tax, which is this right here, just your regular tax, he's also got self-employment tax, which is this right here. So we're adding this ordinary tax plus this self-employed tax to equal his total tax of $38,000. So if he earned the same amount of money as a W-2 employee, he would just have this number right here. He would not have this, but of course he would have paid half of this out as an employee throughout the year by deductions from his paycheck. And as a self-employed person, he does have some benefits. One benefit of which is self-employed health insurance deduction. He pays health insurance as a self-employed person, so he gets that as a deduction. And we'll see that in another calculation coming up. But right now, just you'll see that he's got $10,673 of other deductions, which include those two items, and those show up right here. So before we get to our adjusted gross income, but after total income, we take those as a deduction. So he's got total income of total income of 154. He's got the deductions of the 10,000, so his adjusted gross is 143. At the 143 mark, we then get to take a standard deduction or an itemized deduction. So that's Schedule A. You can see right here from Schedule A. The 12.2 is just a standard deduction, so I don't want to go into it too deeply on this video. But if he had if he had real estate taxes, lots of mortgage interest maybe, lots of charitable contributions, you can see from this schedule, if those total for a single individual that's not a senior citizen, if those total less than $12,200, he's just going to want to take the standard, which is $12,200. And for married, if they total less than $24,400, they will just want to take the standard as well. But if they exceed those amounts, then of course you want to use Schedule A and take the itemized deductions, because you can get, of course, a larger benefit if the itemized deductions are higher than the standard deduction. So if his itemized deductions were higher, then this 12.2 would be replaced by whatever his itemized deductions are. But it's not just as simple as adding mortgage interest, adding real estate taxes, because there's all sorts of caps. You can only deduct up to $10,000 of taxes now, which include sales tax or income tax plus real estate taxes and a few other items, but those are the main ones. And the mortgage interest is now capped at a certain indebtedness. So if you take out a mortgage of $2 million, or let's just say $1 million, it's capped at $750,000, so you can essentially only take 75% of your new mortgage interest. But this guy, regardless, is taking the standard deduction, and then he also gets a qualified business income deduction that's based on his business. He also has some rental income, which if I can get done with this part pretty quickly, we'll go over the rental income. If rental properties could qualify for the QBI as well, but in his case it doesn't. There's a safe harbor. If he doesn't live in the rental property at all, if he or a management company spends a certain amount of time working on the property, then it could be considered a business for the qualified business income deduction. For purposes of this example, we're only looking at his business, his sole proprietorship business. So we need to figure out how to calculate this. And this can be a pretty complicated item to calculate, certainly if you're above a certain wage limit, or taxable income or business income limit, where we have to throw in some new calculations based on wages and net assets. He's not above that limit. For a single individual, it's around a little over 150,000, so he's below that. So that part we won't get into. I will get into that on the complex tax video, but not right now. Essentially, we're looking at in a very high level summary, he gets a 20% deduction on his business income as a qualified business income deduction. But if his taxable income is less than his business income, we have to use the lesser of the two. So the lesser of taxable income or business income, we take 20% of that, and that's his qualified business income deduction. There's many other variables in place, but that's the gist of it. So if we look at his taxable income, he's got $106,791. But this is to calculate this number right here, correct? So we have to remove this number in order to come up with, it'll be a circular reference if we try to use this number to come up with this number. So we take the 24,823 out of the equation. So if we add 24,823 to 106,791, we have 131,614. Another item we have to remove that's not part of the QBI deduction is the long-term capital gain. And remember, that was 500 for capital gain distributions, 2,000 for long-term capital gains, and 5,000 for qualified dividends, a total of $7,500. So we take 106,791 of taxable income, we remove the 24 to get us to 131 of total income, but then we subtract from the 131 the 7,500 of capital gains to get to 124,114. So 124,114 is our base number, and we multiply that by 20%. So if we multiply 124,114, let's just do it on this page right here. 124,114 times 20% is 24,823, which is his qualified business income deduction. So that, of course, is the lesser of the two, because if we look at, for instance, his, because remember, it's a lesser of taxable income or business income. So if we look at his business income, we can actually do it, we can go down to Schedule 1. All right, his business income is 136,376, but then we remove these amounts. So these can be removed, have to be removed, I should say, from his business income to come up with the 20% number. So if we take 136,376, and then we subtract out the 9635, and we subtract out the 1038, we have a base number of 125,703. So right there, you know, we have to use the other number, because remember, the other base number of the taxable income was 124,114. So that's why we came up with the 24,823. It was based on taxable income, because this base number, 136 minus this 10,000, is higher than that base number, and we have to take the lesser of the two. So that's how we come up with the QBI. Like I said, there are a lot of other variables in place that come into play under certain circumstances. We will not go over right now, but I can go over that on another. Okay, so now we are at taxable income, so we need to calculate the actual tax. The tax is, the system is a marginal tax rate. So I just pulled up that same website. If we go to, let's see. A single individual, what I mean by marginal is his first $9,700 is not taxed at his tax rate. It's taxed at 10%. And then the next portion of money from 9,701 to 39,000 is taxed at 12% and so forth. So if we take, here's my little tax calculation spreadsheet. I'll try to narrow this down a little bit, but if we look at his taxable income, it is 106,791. So it's obviously above 9,700, it's above 39, it's above 84. So we're going to go ahead and do these easy calculations first. 9,700 minus 0 is the full 9,700. That's taxed at 10%, so the tax is $970. The next section, 39 minus 9,700 equals 29,000, so the 29,000 is taxed at 12%, so that's $3,500. And then the next section, 84 minus 39 equals the 44, taxed at 22%. That's almost 10 grand. So we've got those three numbers right there. Those are easy. And then remember, his taxable income was 106,791. So we take 106,791, we subtract out the beginning of that threshold, the 84,200, and we have 15,091. 15,091 at 24%. So you see he's in the 24% tax bracket. So that's, if someone asked what tax bracket you're in, he would say 24%. So he takes 24% of the 15,000. That's $3,600. But remember, he had some long-term capital gains, and those are taxed differently. Those are taxed for him, as we saw earlier, at 15%. So he had the 5,000 of qualified dividends, the 2,000 of stock gains that are long-term, and the 500 of capital gain distributions, totaling 7,500, taxed at 15%. So 7,500 times 15% is 1,125. So we need to add 1,125, but since we're doing that, we have to remove that $7,500 portion from that ordinary income tax. So that's what I did right here. If you look at the formula, it's 106,791 minus 84,200 minus 7,500 equals 15,000 times 24% equals 36,221. So if we add all five of these numbers up, we've got 19,129, which if we go back to the tax return, we can see that his ordinary income tax is 19,126. A little bit of a rounding error, but you get it. So 19,126, that's the tax we have, plus self-employment tax of 19,269, which we went over, equals a total tax of 38,000. Now, he knew he was going to be taxed. He knew he was going to make money, so he made estimated payments totaling 40,000. The estimated payments are on Schedule 3, as you can see here. So remember, we start with Schedules 1, 2, 3, then we go Schedule A, B, C, D, that sort of thing, and then we have different forms after that. So if we scroll down to Schedule 3, we can see that he made 2019 estimated tax payments of $40,966. So we put that number here, and of course that number is more than his tax, so he's getting a refund. He did make his payments a little bit late, or maybe one payment a little bit late, so he's showing a small estimated tax penalty. So that $25.71 refund is actually changed to $25.26. So that is I know I said it's basic, and it's not the most basic return would just be a W-2 right here, but I think most people can, you can plug that into a TurboTax or whatever, and there's not really much you need to know about that. But this kind of gives you an idea without getting too complicated. Now I am doing a bookkeeping basic video that's similar to this tax return basic video, and I also have a bookkeeping complex and a tax return complex and a cash flow basic and a cash flow complex. I'd just like to put one of each out there. So the basics are really meant to kind of get a better framework for what's going on here. And here is a temporary little PDF I made of what I'm going over in each of these. So the bookkeeping basics, just how do the financials connect, the profit and loss, the cash flow statement, the balance sheet, the basics of accounting and debits and credits so you can understand it, and so forth. And then the tax returns, and there's the more complex bookkeeping. And then the tax return, this is some of the stuff I'll go over in the complex video. So more how to do flow-throughs, a little more understanding of business tax returns, selling of real estate, different credits that you can use, the QBI in more detail, the home office in more detail, and how to plan. So how to take what you have and plan for the following year and years to come. This return right here, like I said, it's basic, but it's not super basic, and it's got, as you can see, it's got the 1040. It's got those three schedules that we went over. He itemizes deductions, or no, he took the standard, so it doesn't have Schedule A, so it goes straight to Schedule B. Schedule B, interest and dividends. Schedule C is his business. Schedule D would be his stock gain, his capital gains. And when you'll see on the complex video, when he sells his real estate, this will also go on Schedule D because it's an investment property, it's a long-term capital gain. And we'll also go over on the complex video, we'll go over selling the real estate and recapturing the depreciation that he took and things of that nature. So this is just a more detail of his stock sales, the Form 8949. You can see we're getting into forms with numbers now. There's a Schedule E. So this is his rental property. We've already hit 30 minutes, so I had a feeling we wouldn't get to this, but this, he's got income of 25K, some expenses, and the expenses totaling 15,000. So his net income from the real estate, from the rental, is 9,500. So this 9,500, remember we looked at Schedule 1 right here. This 9,500 goes right here. So this line item right here includes rental real estate. It includes pass-through entities and things of that nature. So if you have a partnership interest and you get a K1 from a partnership, it'll be added to this amount right here. And I think that's really the main things I wanted to go over. Yeah. Like I said, I'll do some more videos to go into more detail. I just know 30 minutes is kind of a good limit to go over tax without creating some irritation and boredom. So I will leave it at that, and I hope that helped. Thanks a lot.